Imagine a world where you can profit from the rise and fall of currencies. This is the fascinating realm of Forex trading. It's a dynamic market that never sleeps, offering opportunities around the clock. Whether you're a night owl or an early bird, Forex is always open for business. Forex trading can change your financial perspective. It offers a way to diversify income and build wealth. With the right knowledge and strategy, anyone can tap into this market. And the best part, you don't need a financial background to start. The global currency market is vast and vibrant. It's the largest financial market in the world, with a daily trading volume exceeding $6 trillion. This sheer size provides ample opportunities for traders to make their mark. But what exactly is Forex trading? How does it work? Let's dive into the basics and unlock the secrets of currency exchange. Forex, or foreign exchange, is the process of buying and selling currencies. It's like trading one country's money for another. For instance, exchanging US dollars for euros. This happens over the counter, OTC, meaning trades are conducted directly between parties without a centralized exchange. Currencies are traded in pairs. Each pair consists of a base currency and a quote currency. The price of a pair tells you how much of the quote currency you need to buy 1 unit of the base currency. For example, in the EUR-USD pair, EUR is the base currency and USD is the quote currency. Forex trading involves speculation. Traders predict whether a currency will rise or fall in value compared to another. If they believe the euro will strengthen against the dollar, they buy EUR-USD. If they think it will weaken, they sell EUR-USD. This market operates 24 hours a day, 5 days a week. It spans major financial centers like New York, London, Tokyo, and Sydney. Because of this round-the-clock nature, Forex offers flexibility and accessibility to traders around the world. To navigate the Forex world, you need to know some key terms. Let's start with pips. A pip is the smallest price move in a currency pair. It's usually the 4th decimal point. The spread is the difference between the bid and ask price. A narrow spread means lower costs for traders. Leverage allows control of a large position with a small amount of money. For example, 100 leverage means controlling $100,000 with $1,000. Margin is the money needed to open a leveraged position. Knowing these terms is crucial for understanding market movements. Forex trading starts with choosing a broker. This intermediary provides the platform and tools for trading. Make sure to select a reputable broker with good customer support and competitive spreads. Once you have a broker, it's time to open a trading account. Most brokers offer demo accounts. These are great for beginners to practice trading without risking real money. They simulate real market conditions and help you get comfortable with the platform. After setting up your account, you need to analyze the market. There are 2 main types of analysis, fundamental and technical. Fundamental analysis looks at economic indicators, political events, and other factors that affect currency values. Technical analysis, on the other hand, involves studying price charts and patterns to predict future movements. Placing a trade involves selecting a currency pair, choosing the amount to trade, and deciding whether to buy or sell. You can also set stop loss and take profit levels. These are pre-defined points at which your trade will close to limit losses or secure profits. Understanding these mechanics is essential. It ensures that you can navigate the trading platform efficiently and make informed decisions. One of the biggest benefits of Forex trading is its accessibility. Unlike other financial markets, you don't need a large capital to start. Thanks to leverage, you can control significant positions with a relatively small investment. Another advantage is the market's liquidity. With a daily trading volume of over $6 trillion, there's always someone willing to buy or sell your currency pair. This high liquidity ensures quick execution of trades and tight spreads. Forex trading also offers flexibility. The market operates 24/5, allowing you to trade at any time that suits you. Whether you prefer trading during the day or night, you can find opportunities around the clock. Finally, Forex trading is a great way to diversify your investment portfolio. It provides an alternative to stocks, bonds, and other traditional assets. By trading currencies, you can hedge against risks in other markets and potentially enhance your overall returns. These benefits make Forex trading an appealing option for both beginners and experienced traders. However, it's important to remember that it also comes with risks. Forex trading is not without its risks. The most significant risk is leverage. While it can amplify profits, it can also lead to substantial losses. If the market moves against your position, you could lose more than your initial investment. Another risk is market volatility. Currency prices can fluctuate rapidly due to economic data releases, geopolitical events, and other factors. This unpredictability can result in sudden and significant losses. There's also the risk of emotional trading. Fear and greed can cloud your judgment and lead to poor decisions. It's essential to stay disciplined and stick to your trading plan, regardless of market conditions. Finally, there's the risk of scams. The Forex market is largely unregulated, making it a target for fraudsters. Be wary of brokers or schemes that promise guaranteed returns. Always do your research and choose a reputable broker. Understanding these risks is crucial. It helps you develop a risk management strategy and trade more responsibly. Section 7. The strategies for success. Successful Forex trading requires a solid strategy. One popular strategy is trend trading. This involves identifying and following the direction of the market trend. Traders use technical indicators like moving averages to spot trends and make informed decisions. Another strategy is range trading. This is when the market is moving sideways within a specific range. Traders buy at the bottom of the range and sell at the top. This strategy works well in stable markets with low volatility. Scalping is a short-term strategy. It involves making numerous small trades throughout the day to capture minor price movements. Scalpers rely on tight spreads and quick execution to make profits. Lastly, there's swing trading. This is a medium-term strategy that aims to capture price swings over several days or weeks. Swing traders use both technical and fundamental analysis to identify potential opportunities. Developing a strategy that suits your trading style is key. It helps you stay focused and disciplined, increasing your chances of success. Section 8. The tools of the trade. To excel in Forex trading, you need the right tools. A reliable trading platform is essential. It should be user-friendly and offer advanced charting capabilities, real-time data, and a variety of order types. Charting tools are crucial for technical analysis. They help you visualize price movements and identify patterns. Look for platforms that offer customizable charts, drawing tools, and technical indicators. Economic calendars are also important. They list upcoming economic events and data releases that can impact the Forex market. Staying informed about these events helps you anticipate market movements and plan your trades accordingly. Lastly, consider using trading journals. These are records of your trades, including entry and exit points, profits and losses, and the rationale behind each trade. Reviewing your journal regularly helps you identify strengths and weaknesses in your strategy. Equipped with these tools, you'll be better prepared to navigate the Forex market and make informed trading decisions. Section 9. Real-life examples. Let's look at some real-life examples to understand Forex trading better. Consider a trader who believes the euro will strengthen against the US dollar. They buy EUR/USD at 1.1000. If the pair rises to 1.1050, the trader gains 50 pips. If they use leverage, their profit could be substantial. Another example is a trader who expects the British pound to weaken against the Japanese yen. They sell GBP/JPY at 150.00. If the pair drops to 149.50, they gain 50 pips. Again, leverage can amplify their profits. These examples demonstrate the potential and challenges of Forex trading. Section 10. Conclusion and call to action. Forex trading offers exciting opportunities. It's accessible, flexible, and provides a way to diversify your investments. However, it also comes with risks. Understanding the basics, developing a solid strategy, and using the right tools are crucial for success. If you're new to Forex trading, start with a demo account. Practice trading without risking real money. Learn from your mistakes and refine your strategy. When you're ready, move to a live account and trade with a small amount initially. Remember, trading is a risky but wealthy profession. Always trade responsibly and stay informed about market developments. Subscribe to educational resources and stay updated with the latest news and analysis. This video is for educational purposes only. Trading carries risks, and it's essential to do it at your own risk. Equip yourself with knowledge and trade wisely. Start your Forex trading journey today. With the right approach, you can unlock the secrets of currency exchange and achieve financial success.